Hello, everyone. Welcome to the September 19th edition of the Scientific Governance and Risk Meeting at MakerDAO. My name is Richard Brown. I am the head of community development at Maker, and I forgot, I'm also the interim governance facilitator. All right, I guess I should add that to my resume. Today we are going to mix up the agenda slightly. We have some conflicts that we need to route around. We also have some special guests, and this is going to be fairly exciting. So we have some heavyweights in the room today. Fluidity is here, and they're going to talk about their tokenized asset portfolio mechanism that they released to the community. There was a blog post that went out recently, a paper that went out. There were some very high-level discussions that went along with that post. In my mind, not enough discussions though, because it was worthy of more investigation than it received. And so hopefully we can dig into some of the details today. We have a fairly committed and fairly smart crowd here, so I'm looking forward to the questions we might get. I am going to skip governance until, like I said, the second half of the call. We'll start off with risk. And then, but before we get into that, let's talk about the standard preambles that we've all heard 53 times before, if you're an active listener. We are intensely interested in dealing with issues in the community and answering questions as they arise and hearing what this group is interested in, what it's been up to. So if you have a question or a comment, please feel free to interrupt us. If you have a microphone, just jump right in and ask your questions. If you do not have a microphone, find wherever the chat button happens to be on the UX that you're looking at. Type your question into the side. David or I or someone else will find that question and we'll read it out for you. And so we're really interested in getting feedback from as many people as we possibly can. There's also a forum thread that goes along with this call. Posting a link in the side, just beat David to it. I saw him scrambling for it. If you have a question that doesn't get answered, please ask it there. Follow that thread too, because in the forum is where governance happens in earnest at MakerDAO. There's a tremendous number of very weighty and important discussions happening right now. And we'll also be posting a summary of this call at some point today with video, audio, and trim. Depending on David's schedule, perhaps tomorrow. Soon we'll be publishing a summary of this call. Transcripts will arrive soon afterwards as well, possibly by Monday. So keep an eye on the forums. I am going to turn it over immediately to Vishesh for the state of the peg, and he can show us graphs. I've asked him to put large, bold letters of good and bad with arrows on his graphs so I can follow them along a little bit better, but I'm not sure whether we'll see that today. Vishesh?
And I've refused to put good and bad anywhere in any data because we're not doing that.
Editorialize. Tell us what to do, Vishesh.
How about I show you some data instead? All right. So, yeah, just to kind of cap what's been going on, actually start with this. So the highlight is DAI supply is up a fairly significant amount. Collateral value locked also at a reasonable level, but the main thing is that some refinancing, some just re-uptick in activity, given what's been going on lately with ETH price. We kind of called this shot in the sense that as the stability fee is lowered, if ETH price is doing reasonably or people are feeling reasonably bullish, you will see sort of this re-uptick in leveraging activity. Good news is it's not been so much just a tremendous amount of risk with very little collateral added. It's been kind of a little bit of both. So we're just sort of recovering some of that lost interest in CDP activity before. So overall, I think a rather positive week is a good way of looking at it. What's really interesting is this happened without sort of crashing DAI, which we can talk about that in just a second. So brass tacks, the DAI supply started ticking up around 15th. It was like 4 days ago, with a pretty significant amount of DAI drawn out, roughly about 4.5 million on that day, and very little DAI being wiped during that same time period. What we also saw was a bit more collateral being added. So it looked like about 63,000 ETH. So keeping the collateralization ratio roughly overall for the system around 350%, which is a pretty reasonable level. As far as like long-term trends, so basically it's a very short time frame blip, so it's not really gonna show in the long-term trends just yet, but essentially the pace of the amount of DAI being locked has started to tick back up again, so we can keep an eye on that. And the amount of collateral being freed still pretty flat. And then same with draws and wipes, respectively. So that's pretty reasonable. That's what you expect when you see more of that leveraging behavior. What is also interesting to note is on some of these secondary lending platforms. So, and you have to forgive the data sync was interrupted here, but essentially when that 12.5% stability fee drop occurred, for at least a few days, there wasn't much of a change in activity. And so actually that weighted average borrow rate for DYDX and Compound was above that stability fee, which meant that it was cheaper to open your positions on Maker during that time frame, which is fascinating when that happens. That generally hasn't happened in a while, and should get, you can think of it as arbed away by refinancings. And so let's look at some of those volumes. I mean, they started to dip around the 15th. We need to track where this is at in the last couple days, but essentially the idea is that the borrow volume had kind of slowed and started to dip as more positions were opened on Maker itself, and some of those utilization rates started to dip as well. So we'll resync this and get an
Vishesh,
update on it. Yes.
I have a quick question. So on the 15th, wasn't it like one single CDP or very large loan that just refinanced from Compound to Maker that was basically the majority of that blip?
Yes, generally it's one or two large positions, but what was really interesting is it's not just the refinancing; it's also um, not necessarily new positions being opened, but at least old positions being reopened through new CDPs on Maker. So in addition to what's going on in the secondary lending platforms, which was basically just an arb of those rates, there was also legitimately like new DAI being issued and new activity on Maker. So yes, as far as the refinancing, but that was how it happened the first time as well, right? So we saw when there was that, uptick in activity on Compound through InstaDApp and a large amount of refinancings from Maker to Compound, about 4.5 million moved in one day, primarily through one or two large positions. So it's basically a flipping back, is the way that I see that. But in addition to the flipping back, which is more about the stability fee change, there is also this more recent uptick in activity. So basically this DAI supply around the 16th was about 8.3 to 8.4, or sorry, 83, 84 million. But in the last couple of days, that has ticked up further to about 86 million. So there's an additional like 3 million worth of activity that's not necessarily represented here. In addition, the DAI price. So this is particularly interesting. Slow this. So the DAI price in the last 24 hours, volume is actually kind of low, which is really interesting. So not as much DAI being traded. So these are legit just new positions being opened, not so much people then going and dumping that DAI immediately. Not as much people, buying up DAI, which makes sense because when you have new positions being opened, there's not necessarily a ton of appetite for reacquiring DAI. But usually we do see large volumes in the other direction of selling DAI. So that's particularly interesting. It may still come down the pike in a couple of days or over the next couple of days, but it is fascinating to see that has not sort of cratered the DAI price. And just looking in like the slightly longer time scale, so this is the 7 days. 17 million, pretty reasonable volume for 7 days, slightly higher than we normally see lately. But overall, that price was just below or at $1. So again, not a huge depressive effect on the price of DAI that we might generally expect or worry about. Yeah, so sorry, I'm going to be kind of quick today, but we'll kind of open it up to questions or things that people want to double click on.
I think you might be in the clear for this one, Vishesh. Thanks for that. You get off scot-free. Yeah. All right, so let's keep the momentum up then. So Fluidity is here, and this is fairly exciting. It's a great team. They're doing a lot of really interesting things, and they have a long history in the space. So it's a great opportunity for us to start asking some deep questions, and a great opportunity for me to try and understand what their paper was all about. All right, so Fluidity, who's going to be speaking for you today? Do you want to do some introductions? Let us know who we're talking to.
Yeah, we'll do some quick introductions. We're all going to be presenting different components, so we'll just share. So I'm Mark Fernandez. I'm on the product team here at Fluidity. I've been in the digital asset space for a few years now. Prior to this, worked at a company called Noble, which was a bank that was facilitating settlement for OTC transactions in the space.
I'm Britton Overall. I'm on the product team as well here at Validity. Prior to this was at American Express, launched MX Personal Loans, and before that was a consultant at Accenture.
And I'm Jeff Amico. I'm the company's legal counsel. Before this was a corporate and securities lawyer at Cravath, Swain & Moore here in New York.
Cool. So let me just share here. So thanks again for inviting us to present on this call. I think it's a really good opportunity just to share what we've been seeing in the decentralized finance and overall credit space, and think through and present our ideas on what we think would be a really good inclusion to the MakerDAO system. So just a little bit of background before we get into tokenized asset portfolios, which we'll present in detail, is wanted to give a little background on who we are. So as you may know, Fluidity is the company behind the AirSwap project. AirSwap is one of the leading decentralized exchanges. For those who are not familiar with it, I'd encourage you to check it out. It's an absolutely beautiful product. And I think it's one that's adding a lot of value to the decentralized finance community. When we launched AirSwap, it really allowed us to step back and think through how we can build technology to really widen the impact of decentralized finance and really integrate more traditional aspects of finance that have come about historically throughout the last several decades. And we basically turned our focus to how we can integrate capital markets into decentralized finance. And so for the past year, we've focused on what applications and technology we could build to facilitate that. So we've done things like in the past year, we did a tokenization of a real estate debt issuance. We actually integrated the use of DAI to pay for pay interest to investors and actually allow investors to invest in DAI to buy security tokens. And that was the first example of that actually ever occurring. We've also just tried to build mindshare around the capital markets and decentralized finance community. So we've hosted several events. We had one earlier this year, which is our biggest event called Fluidity Summit. And actually during that event, the MakerDAO Foundation presented the plan around MCD. And Greg from the team presented his views, and we actually incorporated a lot of those views into the tokenized asset portfolios that we'll present. So we as Fluidity, we're very invested in seeing decentralized finance as a movement and a technology grow. And as we've tracked this over the last several months, years really, is we've really seen that DAI becoming a cornerstone of decentralized finance. And we think that for us to grow as a firm, we want decentralized finance to grow. And in order for that to grow, we want DAI to grow as well. So we've started to focus on how we can build mindshare within the community and specifically do our part to help DAI grow. And so we released tokenized asset portfolios earlier this year under the intention of allowing synthetic assets to be used in MCD. And we think that's really going to be a way for DAI to grow significantly beyond what it already has grown to now and what it will be when MCD launches.
Yeah, and as Mark mentioned, one of the things that MakerDAO has recognized is the need to bring in synthetic assets to really grow DAI. And one thing that we've really focused on, as he mentioned, was how we can bring some of the first assets into the system. And one of the things that we've noticed that could be major challenges to that are the two main things are just the oracles that will be needed to monitor the price and position data for any assets that's introduced, and also all of the mechanisms that are in place to ensure that the liquidation process can occur seamlessly and the keepers are ensured that they're going to get the proceeds of that liquidation. And so we introduced the tokenized asset portfolio as a way to help solve that. And what that is essentially a structure that covers both the legal, operational, tech, and kind of brings together one framework to be able to introduce that asset into the ecosystem, and for that asset to be used throughout the process. We can probably go to the next. We introduced that, as Mark mentioned, in July, and we released a white paper along with that. That can be found at tap.fluidity.io. We'll also give a little more detail. Jeff will go into that here in a bit on exactly what that is. We used this structure in July in a pilot that we did with U.S. Treasuries. And we use U.S. Treasuries for a number of reasons. Mark will go into a little bit more why we chose U.S. Treasuries and why we think that's a good fit later. But we put this through the TAP structure and essentially went through a process of mimicking how this would work end-to-end in the MakerDAO system in the test environment. And we broke this down into really three main stages. One was, and the first being the pledging process. So we bought treasuries and held that through a broker and custodian, and created tokens to represent those treasuries or that TAP, that portfolio of treasuries. We then pledged that token to initialize a DAI credit line and withdrew test DAI. We then created oracles to mimic what the MCD system would have in place to monitor the price and position, and monitored that throughout the course of a few days and confirmed that the treasuries were in fact held still with the custodian and that the price had fluctuated in such a way that it was still above the OC ratio. And then we went through the process of withdrawing the DAI. So we returned the test DAI and closed out the CDP, and then sold the treasuries and burned those tokens. All of this we did over the course of a few days, and there's a lot more detail of each one of these steps in the white paper at tap.fluidity.io.
Yeah, so this is Jeff. So maybe I'll just briefly walk through some of the legal mechanics, both in the version that we set out in July and then some of the kind of revisions that we've made since then. So it's critical in our view in introducing synthetic assets to ensure a few things. One, that you need to ensure that the underlying collateral is not being repledged. It's not being rehypothecated. It's not being sold off chain. in a way that the MCD system can't detect. And then in a liquidation, you need to be able to minimize the counterparty risk of the sponsor essentially defaulting and not allowing the keepers or the system to be made whole in a safe and efficient way. And so we introduced, as Britton mentioned, the white paper in late July. And that was really an effort to start the conversation about introducing synthetic assets in a serious way. And it was a serious effort to really design the legal technology necessary to facilitate synthetic assets being introduced to MCD. And so, as I kind of mentioned, the feedback that we got from the Maker community, from the Ethereum community, and really from the broader legal and financial community was terrific. And since then, we've been in the process of incorporating that feedback such that we could really bring to market an application for MCD that was as strong and robust as possible. And so maybe if we, Mark, I'm going to switch it over. So this is kind of a high-level overview of the proposed flow. And I think really the takeaway for this, at least at an initial glance, is that a counterparty who is using this system to borrow from the DAI system against their traditional assets like Treasuries would begin with depositing those assets into the account of a regulated trust company. And so we think that the way to ultimately address some of the concerns around synthetic assets regarding ensuring the safety and the integrity of the collateral and also facilitating liquidations, we think that in the near term that the best way to address those is to introduce a regulated and chartered trust company to facilitate that piece of the workflow. And so,
can I interrupt for just one second for a question? So obviously, it's interacting with the real world involves trust. Unfortunately, so it's something we might have to accept. How is that trust, or how is the transparency managed there? Is the recourse here regulations and the law essentially that the custody has to be maintained in a way that's compliant, or is there some kind of mechanical oracle like on-chain mechanism that proves that the existence of these assets?
Right, yeah, so that's a good question, Rich. So it's a few things. I think first you have an oracle that will connect to the trust's custody account at all times, such that the MCD system will know that the securities are being held there and that they haven't been transferred to a different brokerage account, for instance. And then, so that's kind of how you ensure provenance while the CDP is open. And then in the event that a liquidation does occur, some of the feedback that we got when we introduced the white paper was, well, how does a keeper know that they're going to be made whole in the event that a CDP liquidates? If, for instance, a sponsor could enter insolvency, declare bankruptcy, and put a stay on all of the assets. And the way that we're addressing that is by designating the keepers, so the holders of the token that are being issued by the trust. Those holders will actually be the legal beneficiaries of the trust account. And so that entity will have a legal obligation to maximize the value and to kind of turn that value over to the keepers, even in the event that Fluidity or whoever the sponsor is has become insolvent, non-responsive, or non-cooperative. So it's a combination of both the kind of on-chain oracle mechanism as well as some kind of traditional legal safeguards as well.
Yeah, it feels like there's a rabbit hole here that we could go down endlessly, though. But if it had to go to the courts, so there was only legal recourse here, who would be the representative for infrastructure? So who would be in charge of accepting like those payouts from whatever settlement occurred?
Well, so I think the introduction of the trust really should eliminate the need for a keeper to, say, sue Fluidity or a different sponsor in a bankruptcy court, because, like I said, this trust account will be bankruptcy remote from Fluidity. And so once a liquidation happens, the trust will have instructions to liquidate the collateral, to hold the pool of money in its account. And then once the keepers who have purchased the token from the CDP, once they bring those tokens back to the trust by depositing them in the trust's wallet, then the trust will simply give them $1 for every token that they've deposited. So it comes to resemble some of the other asset-backed stablecoins that are currently in the ecosystem. And I think that allows the Maker community to have comfort that there is always a sufficient amount of collateral backing the token, and that the liquidation could happen in a seamless fashion, even if Fluidity had disappeared from the picture.
All right, so I think I understand now. So the trust is an independent third party whose existence is just to ensure that recourse happens effectively.
Exactly.
Okay.
I have a quick question here. I don't know. I can't see if anybody else was talking, so if somebody else has something to say, I can wait.
Yep, go ahead.
Okay, sure. So I want to make sure I understand the redemption process. One of the features that I really like in particular about the Maker system and its current composition is the permissionlessness of the keeping process. In other words, that anybody, a piece of software, anybody in the world can participate and be a keeper and do so on par with everybody else, insofar as they have access at least to an exchange to be able to offload DAI, whether that exchange be on-chain or not. So is it the case here that the redemption flow that you just described is open to anybody no matter where they are? Or are there restrictions to which types of persons or legal entities can participate in that redemption process?
Yeah, so the way that we're envisioning this, and I would say that this portion is still being hammered out, but the way that we envision this is that for participants for keepers who purchase the token and want to kind of permissionlessly just receive DAI in return, there will be a way for them to do that by interacting with Fluidity. And assuming that Fluidity is in the picture, is solvent, then we'll happily just simply return an equivalent amount of DAI for every token that's deposited. The trust mechanism that I just described is really a last resort, and that's simply there in the event that Fluidity is no longer in the picture and the keepers need some way to get value back for the tokens that they purchased. Because it's a regulated trust entity, they're going to need to do kind of regular way KYC on the participants who are bringing that token back. And so any transaction would need to comply with applicable laws that they're subject to, but we don't really envision that materially restricting the type of people who could bring a token back, so long as they weren't sanctioned or on any sort of traditional kind of AML lists that would restrict our trust from transacting with them. So outside of that small kind of edge case within an edge case, this system should be open to anyone who wants to kind of redeem the token from us in liquidation.
Got it. Is it the case that it should be open and relatively open, except for, as you mentioned, some edge cases? Is there a difference in cost in order to participate in that system? Or is it the case, for instance, that a US person with a US entity with a US bank account who can be KYC by a US bank can participate in this process more cheaply than a person that is on no list that happens to be, let's say, in Korea or China or somewhere else in the world?
No, there wouldn't be a difference in cost as far as performing KYC or anything like that.
Got it.
I have a quick question.
Yep.
What is the anticipated time duration of any given recourse? Like, let's say CDP gets liquidated. How long before the keeper actually gets paid?
Yeah, so I think part of this is one of the reasons why we selected Treasuries to be introduced as an asset type to be used as collateral is the introduction of MCD. As Jeff mentioned, part of the process in liquidation would involve the keeper bringing the token to Validity or the trust that would then be able to provide them with DAI or USD in return for that token. That presumes that that entity, either the sponsor, Validity, or the trust was able to liquidate the underlying collateral. We think that Treasuries, and we have a slide on this in a little bit, we think that Treasuries are in fact one of the most liquid assets. The market depth for Treasuries is enormous. And so we think that it would be very feasible for any sort of entity that needs to liquidate the underlying assets to do so in a very timely fashion. So we think that that could happen all in the same day. We don't think that the process would be much more lengthy than, say, ETH.
So would you say that the process is optimized to minimize slippage by like trying to keep the spread of time between liquidation and actually liquidating it, the actual underlying assets, minimal?
Yeah, we think that that's the case. We also think that there would be safeguards to prevent this from getting to liquidation. As the manager of the assets in the trust, Validity would be basically maintaining the fact that these assets are getting close to liquidation, and we would be able to maybe facilitate any actions that need to be done in preparation for a liquidation. So it's sort of active monitoring, but if that was to happen, we think that these could be liquidated very quickly and avoid and slippage or minimize slippage, as you mentioned.
Cool, thank you.
I have a quick question before you move on. It looks like there's a lot of middlemen here. You know, there's the custodian, there's the trust, there's the exchange. So doesn't all of this leave less of a profit margin for the end users? And like, is there a way to get rid of some of these middlemen?
Yeah, so it's a good question. I think it's ultimately a balance between reducing intermediaries and potentially, as you mentioned, increasing margins, but also, on the other hand, using a system that is robust and kind of can maintain the integrity of the DAI system even in the event of a liquidation. And so the introduction of things like custodians and trusts, while perhaps not optimal from a margin perspective, I think is ultimately necessary, perhaps for the entirety of the synthetic asset segment, but certainly at least for something like this, in our opinion, to really give the system assurance that in the event that a CDP that was backed by an asset like this liquidated, that the keepers would be made whole. And it really kind of, the introduction of those intermediaries is designed to eliminate some of the counterparty risk that is inherent to introducing synthetic assets. And so while it's not optimal, I think it's probably necessary.
So I think we could jump forward here. We talked through the liquidation process at a high level here. What we want to talk through now is the introduction of a new questionnaire to supplement synthetic assets.
Yeah, so back in July when we ran the pilot, it was around the time that the community had posted the onboarding guide, collateral onboarding guide. And we had taken a look through that, and it was really comprehensive and really helped guide a lot of kind of the questions that we needed to ask ourselves in that process. But one thing that we noticed was that there were some room for improvement after we had gone through the process that we thought could be added for synthetic assets, and some important questions that we thought could be raised there. I'm posting a link in the group chat to a post that we did actually this morning about some of these additions that we are proposing for that. And we really bucketed these into 3 categories. One is around the risks that the particular asset is introducing. and some of the considerations that would be needed there just to make sure that a particular asset is not too risky for the Maker system. The second is oracles. So it's very important that any asset that gets introduced, that the position or that asset is held can be confirmed, and then also that there is a data feed that has accurate pricing to know the value of that asset at any time, to make sure that it's falling within the collateralization ratio and the system as a whole is collateralized, and that all of that data is available. The third is the liquidation, and I know we spent some time already talking about that, but the right structure needs to be in place for that to make sure that all of the scenarios that could happen in that process are buttoned up, and the right mechanics are there and legal rights are in place. So we've posted some questions. We could probably flip over just to show the post. Won't go into all the details, but essentially everything is the same on the tech section and the original financial section. We've added some other items which can be seen there in bold that we think are some additional questions that we might want to ask if there are other synthetic assets that are introduced. So feel free to take a look there. We welcome any feedback from the community on those. And again, it's just our kind of recommendation of some things, and I'm sure there'll be many more questions that come up along the way as more folks introduce synthetics.
What is the primary reasons for augmenting that checklist? Is it because synthetic has so many real-world interactions as opposed to straight crypto?
Yeah, exactly. Since there is, like Jeff went over with introducing a trust and some of these outside third parties, making sure that structure is in place and that the asset that being introduced can fall into those structures correctly. That's one of them. And then, given that a lot of this data is not going to sit on chain, it's going to sit off chain and need an oracle to kind of bring that on, then all of the details on how that data is generated and the availability of that data is important to know.
Yeah, just to provide a tiny bit of context there, when we were originally designing that guide, we specifically designed it for crypto assets because at the time we weren't expecting this level of demand from off-chain assets this early in the process. Our original version actually had some sections on security tokens, but we thought that there was sufficiently unanswered questions that we weren't even sure how to structure it. So we structured it for crypto assets specifically, but this is great. We're definitely happy to have kind of a first pass at what the process might look like for synthetic assets. So thank you for that. We'll be sure to give it a look.
Yeah, absolutely.
Cool. So our goal with this application and working with the larger Maker community is to ultimately submit an application for treasuries using the TAP structure to be introduced as a type of collateral in the MCD system. Our position is that treasuries would be an essential or at least very, very important type of collateral to have within MCD. We think that in order for DAI to scale, it really requires users to be confident that DAI is backed by a sufficient amount of collateral. And you can really increase that confidence with DAI holders by backing DAI with a collateral that has a low likelihood of liquidation. And we think that because treasuries are extremely stable, the likelihood of liquidation is very low. For example, if you look at the 95th percentile of a one-day movement of 3-month treasuries, it's less than 10 basis points. However, you compare that to something like ETH, it's 16%. So we think that treasuries are very, very stable, presents a very low liquidation risk, and therefore maintains the integrity of DAI. However, as we've somewhat alluded to before, there may be scenarios, hopefully never, but we think there could at some point be a scenario where these assets, the underlying collateral, needs to be liquidated. And in such a scenario, it is really important, as we mentioned, for the underlying collateral to be liquidated. As I mentioned before, the depth of the market for treasuries is extremely large. The US Treasury market is around $15 trillion worth of treasuries, and a substantial amount is traded every day. So we do not think that there would be any issues in liquidating treasuries in a scenario of a CDP liquidation relative to potentially other synthetic types of collateral which may present some liquidity issues. And then finally, we think that when we introduce treasuries as a type of collateral, the maker community will actually gain a lot more control over the supply of DAI and therefore be able to increase the control of the peg of DAI to $1. And this really stems from the fact that treasuries are a fixed income product, meaning that they have a fixed rate of return. When there's a fixed rate of return, CDP users can really easily assess the economics of if it makes sense to open up or close CDPs, because they have an understanding of what the rate of return of treasuries are relative to the stability fee. This is really different from an asset like ETH, where it's unclear what the return on ETH would be. There's a lot of speculation, there's a lot of volatility, and therefore it's tougher to make a judgment if it makes economic sense for you to open up or close your CDP. When you have a very stable asset like treasuries introduced to the system, which has a fixed rate of return, it makes that evaluation a lot more direct and a lot clearer. So the process of trying to maintain a peg of DAI to $1 or some other peg is it's a lot more straightforward of a process. So we think for these reasons, and there are probably some others, but we think these are the most important, we think treasuries should be introduced as a type of collateral.
Could I interrupt with a question here?
Yep.
So you make the point that because treasuries have a fixed rate of return, that it's very easy to see when that rate of return exceeds or is less than the stability rate, right?
Yes.
So would that not just lead to like the entire collateral pool for treasuries either disappearing or like reappearing based on when it crosses that fixed threshold?
We think that there would be some users that have positions that are based on their loans of DAI that they can't immediately get out of. And so there won't be like an immediate action to close CDPs. But yeah, we think that based on how users are using their DAI to get a return elsewhere, there may be a need to close the CDP if the stability fee is too high. Let's say if they opened up a CDP in order to access DAI, and that DAI is really the only type of collateral that is used in another system to get a return, maybe it's important for them to keep their CDP open even though the rate is high.
Right, I see, thanks.
So what we aim to do in the next several months is really work with the larger maker community to really see that MCD goes live in a smooth fashion, and that we incorporate collateral types that will allow DAI to scale. As we mentioned, as a company, Validity is very tied to the success of decentralized finance, and that means we're really tied to the success of DAI. So we really want to see this move forward, and we're open to working with the community to really push tokenized asset portfolios forward and enhance the system. So with that, we can open it up for questions or turn it back to you, Rich.
I have another question, if you don't mind, Rich, but I know you have your agenda, so if we gotta move on.
No, jump in, Alex. What do you have?
So just a little bit on a more philosophical point. Let's say this framework gets adopted by the maker community for issuing tokenized asset portfolios, and let's say, for the sake of argument, some significant portion of our collateral is generated in this process. Let's say that percentage is 80, 90% for the sake of argument. What then do you think differentiates the maker's system for creating DAI from, let's say, Tether or any other fiat collateralized stablecoin scheme, insofar as a lot of the recourse and mechanisms start to look a little bit similar in this model? Why do you think Maker continues to be a better, more trust minimized alternative to those systems in that world?
Well, I mean, ultimately users are still, or they have the option to still open up CDPs in the way that they do now, in a fully permissionless way. Even, as I mentioned, even if, treasuries do make up a substantial portion, that doesn't restrict the ability of other users to continue in the kind of current status quo method of kind of opening up CDPs against Ether or against other types of kind of crypto native assets. And so it's ultimately just a different option for potentially a different user of the system.
Additionally, the mechanisms by which the risk is monitored and controlled for synthetic assets remains the same. So a stability fee and over-collateralization rate, that is still completely decentralized and voted upon by the Maker community. So even if treasuries are included as part of the system, it's different from these other types of stablecoin projects in that the decision-making is still decentralized across a wider base, which has control over the risk and managing it in a way that's really benefits the entire community.
Great, thank you. One of the things there that's interesting that we don't need to open up a whole conversation about is, as some of those mechanisms around over-collateralization, about oracles and stuff have to do with some of the collateral that we're using in the system being volatile. So let's say we were to adopt a similar scheme to this, and instead of treasuries, we just had it literally be US dollars sitting in a bank account or in a trust or a mechanism like the very elegant one that you described. Then some of those mechanisms kind of become unnecessary insofar as we know that DAI has a target of $1, and if it's backed by dollars somewhere in a trust, then some of those mechanisms aren't fully required of us to really vote on, because really the answer is how many dollars should be backing each DAI in that world. So I guess that's a long way of saying of, let's say it wasn't treasuries, let's say it was dollars. And again, same question. Let's say the majority of the system relies on a system like this, or at least the majority of collateral is based on a system like this, and only a minority is based on ETH. Now, it's true, I grant you the point that we have access to other options, but if it is de facto the primary way through which DAI is issued, how do you think of a third party looks at DAI, the asset, from a risk perspective? Do you think it starts looking more similar to something like USDC, or do you think it's mainly the option of having different forms of collateral that do DAI?
Yeah, I mean, it's a fair point. I think another distinction, though, that should be raised against something like USDC is the option to obtain leverage in DAI, which is not available in the kind of USDC, at least within its own kind of operation. You can, of course, borrow something like USDC or lend it on something like Compound, but it doesn't offer you the option to obtain leverage in the same way that the Maker system does. So I think that is something that continues to distinguish DAI from the other stablecoins, and the fact that you can do that permissionlessly, and that the kind of the rates and the thresholds and the ratios are all set by, and will continue to be set by the community, I think will continue to distinguish this from something like USDC.
I think the question might be more from the user's point of view. So the point of view from the person deciding whether they want to put their savings in USDC or DAI or something. The more US treasuries, the more US dollars that come into DAI, the more it starts being similar to USDC, to USD, whatever.
Yeah, we think that there's probably going to be, in the ecosystem, several different options. We think that maybe there are certain applications that are really only focused on one type of stablecoin, only focused on accepting transactions in DAI. So it may be advantageous for you to open up your CDP in DAI. So I think as there's growth in the ecosystem and there are use cases for DAI that the use case is increased for DAI, there may be reasons for you to use DAI over other stablecoins. And so this would provide you with a mechanism to do so as an alternative.
Is there anything to say about the fact that there's that counterparty risk for centralized, like fiat-backed stablecoins, that like backdoor risk that DAI doesn't carry, at least doesn't carry directly? I know if it's backed by, let's say some stablecoin or something that does have a sort of counterparty risk attached to it, like a tap or something, right? That risk does end up being part of DAI, but maybe not as explicitly to the user, right? I don't know, I'm thinking out loud.
Yeah, no, it's a good point. I guess I would say two things. I think one, I think that there's always some degree of theoretical regulatory shutdown risk, if you want to call it that, the kind of backdoor risk. And while it may not be as explicit with the kind of non-synthetic version of MCD, there are still regulatory choke points that I think could be exploited if a regulator truly wanted to throw a wrench into the Maker system and really even the broader kind of Ethereum or crypto system if they truly wanted to. So I guess that is the first point. I think there's always that kind of risk that's present. And I guess the second point would be that relatedly, there's just a balance and a kind of a trade-off that is present here. And we think that the value of increasing the demand for DAI, potentially significantly so, and doing it in a trusted and kind of stable fashion like we're proposing is greater than the increased kind of backdoor risk, if you will. But I do agree that there is a trade-off there, but we ultimately think that the trade-off is worth it.
Chris is actually asking
a question.
Point. Yeah.
Do you have access to a microphone? Did we just lose it?
Potentially. I could read it out. So Chris Smith wrote, perhaps I missed this. What are the use cases for treasuries for users outside outside of collateral and MCD, i.e., other than to make a CDP, why would a user want to hold a tap? Are taps going to, to extend this question, are taps going to be something of just even a basic investment vehicle for anybody that can like legally own one?
No, so we're actually designing these for the specific use case of collateralizing CDPs. They're not meant to be kind of a general purpose stablecoin or a security token or anything like that. It's purely a receipt whose sole purpose is to sit inside of a CDP and to reflect the value of the underlying treasuries that are held in the trust account. And so it's really it's a technology that allows a kind of traditional participant to access leverage against treasuries from the Maker system.
Got it.
I have a question as well. So there's a lot of moving pieces here. How much of this mini ecosystem that you've designed, how much of it has been built, and how far are you from launch?
So maybe I'll leave the tech build question to Mark and Britton, but we're pretty far along in conversations with trust partners who understand the structure that we're talking about, who think that they can handle things like liquidations and managing redemptions of tokens and things like that. So the overall structure, we're pretty confident from a legal standpoint works, and maybe I'll turn it over to you guys to otherwise address.
Yeah, and you can see a lot of this in our white paper, but we've built out the contracts and inherently the tokens that would be pledged, along with the accessory scripts that were used to interact with MCD. And we also built oracles off of one of the custodians we're working with in the pilot. And all of that has been published and is out there on GitHub. Obviously, with some of the updates that have been made, there will be some new build required to interact with the trust and probably build in more comprehensive oracles once the risk teams on the maker side, really want to integrate those oracles. But a lot of this has been built and it's kind of ready to go pending the community's approval.
All right, that's exciting stuff. Thank you guys for your time. We're at the top of the hour now, so traditionally we wrap things up for people that actually have other work to do, because apparently there are things other than Maker in this world. If people do have some free time, though, we will stick around for 15, 20 minutes and just have a general Q&A session. So Fluidity, feel free to stick around if you want to, or feel free to bounce if you have to. But thank you for the presentation. It was very enlightening. A lot of really interesting questions. I'm looking forward to seeing how it integrates in the future. So thank you, guys.
Thanks, Vishesh.
All right, as I just alluded to, it's the top of the hour. So if you do have to bounce, feel free. We are going to stick around and do some general Q&A. We also need to get to some of our regularly scheduled parts of the call, which are related to governance. I'm probably going to see if there's free time for me to talk about what I was going to speechify on. But LongForWisdom, if you wanted to give us a review of what's happening in the forums.
I can do. I actually had one more question for Fluidity if they're still here and around.
Sure, yeah, grab them before they're gone.
Yeah, go ahead.
Yeah, so I believe you said that the keepers wouldn't be required to KYC in order to take part in collateral auctions. Is that correct? Was I understanding correctly?
Yeah, so in the event, in the kind of 99% of scenarios of liquidation where Fluidity was performing, then they could simply deposit the token and would be would receive an appropriate amount of DAI in return, and would very likely not need to get KYC'd or anything along those lines. It's really only in the case where they're interacting directly with the trust that they would need to go through KYC.
Okay, so my question is an extension of that, is if we're forced to do global settlements, if Fluidity is still around, can they then redeem those tokens for all holders of DAI or previous holders of DAI?
Sorry, what do you mean by global settlement exactly?
So if the system shuts down and DAI becomes a voucher to get a share of the collateral that was in the system, would Fluidity be able to redeem that collateral for any DAI holder?
Yeah, I mean, I don't see why not. I mean, Mark or Brent, if there's anything that springs to mind.
Yeah, I mean, the structure we built is that anyone who comes to us that has a tap token could redeem it for the value of that. The global settlement, is there a specific scenario that's different? Sorry.
I don't think the scenario is, I mean, the scenario is that the DAI system the DAI credit system is shut down completely, right? Everyone holding DAI gets, it's like a share of the collateral that's backing the system.
Right, so the holders who end up with the share of that's tap token would then be able to come to Fluidity and or the trust and redeem that for the value of that.
Is it also tradable? So if like every single DAI holder doesn't want to do this, can they trade it to someone else who then can redeem it?
Theoretically, yes, but it would, I mean, I think the short answer is yes, but it should be pretty straightforward for a keeper to simply redeem for the equivalent amount of DAI. And so I imagine that that's what most keepers would do, but theoretically, yes.
Well, in this case, people are trying to get rid of DAI rather than keep DAI, right? DAI is no longer stable and is not wanted. They want the collateral behind DAI.
Yeah, so in that case, they would come to us. We would have the treasuries sitting in the trust. We would liquidate the treasuries and be able to give them back US dollars, as an example.
Okay, great, thanks.
And if, of course, fluidity isn't a going concern or is bankrupt for some reason or is required by some government or some entity to do KYC on those users, then the event of global settlement, every DAI holder would have to find a way to transfer that DAI to somebody who did have access to the ability to redeem, because you would not retain the ability to redeem that DAI.
At the same time, there's also a different scenario where DAI holders, instead of redeeming for underlying collateral, can just sell their DAI on an exchange for their desired collateral. And then the ones who actually do the redemption of DAI for underlying collateral or might be like the bigger keepers who are kind of established KYC entities who have a lot of float, who like have the capacity to actually like deal with that. But again, like it's kind of conceptual. I don't know how it will work in practice.
So that's kind of what I'm trying to confirm. Is the token fungible? Like, can it be traded between users?
Yeah, there would be no transfer restrictions. So if the keeper were to acquire that, and then let's just say in the rare event that the Fluidity was insolvent, then if they wanted to transfer that to someone else, who then would go through the KYC process with the trust and redeem those for the proceeds, they could do that.
Great.
Just to double confirm, the trust is a separate entity from Fluidity, completely independent, or is a wing of Fluidity?
It's a totally separate entity, and it's a chartered trust company. So it has a charter that is essentially the same as a banking charter, so highly regulated
and sheltered from Fluidity and the rest of the market.
Yes.
Yeah. So
I have a quick question. My internet cut out for the last 5 minutes, so this may have been asked already. So from my perspective, it seems like the majority of the questions are generally regulatory in nature. That kind of the risk aspect of the underlying asset, the treasuries, is pretty well understood. Assets has been trading for quite some time. So my question is, what are your guys' thoughts, and the communities as well, on bringing in some independent, legal-focused risk teams to kind of evaluate the structure of the whole process and kind of put some answers to some of these questions? Obviously, I'm sure you guys have done enormous amounts of due diligence on this, but how can we bring in some, I guess, third-party external counsel to kind of help evaluate with some of these questions?
Yeah, it's a good question. I think to some extent, the process has already, we've gotten a significant amount of feedback kind of informally following the release of the white paper, which has been incredibly helpful in kind of rounding out the legal mechanics here. And in parallel with that, we've also been working with external counsel on structuring this and getting assurance that it complies with all applicable regulations. But of course, would welcome further feedback from the community, and whether that's just informal or through kind of more formalized legal structures or panels or things like that. Ultimately, we want to get this right, and so we're looking for as much feedback as possible.
Yeah, because one thing, and this is just kind of my impression, is that there's just a fair amount of regulatory uncertainty in the crypto industry as a whole, right?
Yep.
I feel like plenty of the crypto lawyers are just kind of waiting for more guidance from the relevant agencies. To what extent should that risk be mitigated by just, for example, waiting for more clarity? Or, because I mean, are there what counsel is able to even make the necessary, give the necessary opinions or give any sort of useful guidance for the MKR community at this point?
I mean, there are pretty significant law firms who are counseling clients in this space, as I'm sure you guys know. as far as the risk, I think an agency like, say, the SEC is they play it pretty close to the vest. That said, I think they do kind of provide some guidance as to certain structures that they think are okay. We think that, at least with respect to those regulations, that this instrument complies with their frameworks. And we've also kind of examined this under other regulatory regimes and feel that it complies as well. All to say, there's always, in any kind of new emerging technology, there's always going to be regulatory gray areas. And so you just kind of, you develop technologies that sometimes develop and grow faster than the rules do. And so it's just a matter of the rules kind of playing catch up and evolving as necessary. But we, I think, have done the best job possible in structuring this along the lines of what the SEC and other regulators have established as their view on this industry. And so, there's ultimately kind of a balance that needs to be struck, but we think that we've come out on the right side of it.
Okay, thanks. Yeah, so I guess on the heels of that answer, I guess maybe the community should think about discussing how they can, seek some independent opinions from relevant law firms regarding all this.
That would be an interesting exercise in self-organization. That'd be interesting. Chris Smith, you had another comment. Did you find your mute button yet? Did you want to?
I did. I was just adding to the global settlement conversation with Fluidity holding DAI under normal circumstances, as I understand it, to redeem for cap holders. Fluidity itself would end up with a DAI reserve during global settlement that they would have to cash in and redeem for their proportion of the collateral that goes through global settlement, which would then potentially be useful for cashing out any remaining tap collateral against the collateral taken from global settlement without having to liquidate the trust. So it's not a question, Rich. I was just adding to the end of that conversation.
Sure, it was an interesting addition, though. So, all right, we're going to talk about governance at a glance, but that doesn't mean we're not going to ask questions. So, if people still have some things they want to clarify, or something occurs to them over the next 5 or 10 minutes, feel free to type a question in the chat or interrupt us. But I would like to get an opportunity to see what's been happening, because I know that there's a few interesting things happening in the governance world right now. So, LongForWisdom, if you want to take it over.
Yeah, sure. Okay, so not been too many new discussions this week. The main one has been around stablecoins as collateral. So again, without wanting to derail things too much, there's been some discussion on that. Rune shared his thoughts on the value of stablecoins as collateral, basically useful for market makers. And a couple of other people made some comments on the downsides. This is all sort of tied into the TUSD onboarding application. So the other discussion that's been continuing is the discussion on the DSR and the initial values that Cyrus prompted last week with his blog post. So again, just everyone's talking about that, trying to figure out where we should start DSR. Generally, people seem to think between 0 and 5%, which is a pretty big range, but I'm sure we'll narrow it down. So then the other interesting things that have been going on are the signal request threads. So the exponential rate setting threads is coming to what looks like an end. It looks like that's moving on chain soon. Rich, do you want to comment at all? Or?
I could. I was hoping that you would do it for me, though. Here we go. There's a very long thread. A lot of interesting things happened there. We're kind of slightly out of time, so I'm going to dig up a link in one window when I'm talking in another one for people to review. Yeah, there's a summary I posted in that thread about the journey that we went on over the last couple of months to get to the decision to introduce exponential rate stepping to the stability fee. There's some interesting takeaways that we could possibly derive from this around levels of debates, what we feel adequate consensus actually is, how do we measure majorities, all kinds of either interesting or exhausting philosophical questions that we've been wrestling with for a long time now. So it's worth a review. The short version of this story, though, is that the community has self-organized, established process, polled, debated, and come to a conclusion, which is amazing. It's actually astounding. So what's happening now is the forum poll succeeded. The contents of the governance poll has been determined, and it's now in the queue. So on Monday, Maker token holders will have the opportunity to change the way we determine, or the way that we poll for stability fees in the future. It's no longer linear from -4 to +4 of the current stability fee. It is exponential, so people will have a range from, I believe, 0.25 up to 4 to alter the fee every time. So it gives us a finer grained tool for adjusting stability fees. It gives us the same latitude that we had in the existing linear world that we lived in. It also, and this is what I'm most excited about, gives us the opportunity to get rid of that 0.5 off the stability fee, because it's a lot of typing week after week after week. So perhaps the community will align just to clean up the floats that we have laying around in these governance systems. So that's the takeaway there. We have the community is also applying the same work ethic to the cadence question we have around stability fee. Do we need to vote every week on this thing? Community is discussing that now, and there's a new thread in the forum I would encourage people to take a look at and make your voice heard.
Yeah, so just a bit of a note on that. There's currently, I think, 4 days left on like the initial stage, and like currently it looks like people want to maintain the current cadence. So if you're one of the people that believe strongly that we should move to 2 weeks or 3 weeks or a month or anything other than 1 week, like go to that thread and vote and like discuss and share and try and convince people that we should go to 2 weeks, because otherwise nothing's going to change.
We're still in this process of figuring out how much debate is adequate, and that's a hard one. There's no algorithm for determining that kind of stuff. So we're feeling it out, whether the community, the royal we, arrives at the decision that everybody gets a week to figure this out. And if you miss that bus, then it's too bad. It's going through a governance portal anyways. That's one world we could live in. The other one is maybe after the conversations tail off long enough, somebody can stick a fork in it, and then we start the countdown timer. There's only 1 week left to complain. So there's interesting questions that still need to be answered around how much debate is enough, how much consensus is enough, how do we determine whether consensus exists, how do we adequately poll for opinions, there's all kinds of there's interesting questions still to be answered. So if you're interested in the future of MakerDAO, if you're interested in governance, please check out those 2 polls and get involved with the signaling process, because it's going to have some outsized effects on the future.
So there's one last signaling request which I created just recently. So that's referring to the debt ceiling. So this kind of came up before, and we discussed it a bunch. This is sort of before we figured out a little more concretely what the process should look like. Basically, a couple of people have said, both in the forum and in the chat, that it might be good to do a formal sort of discussion and signal request relating to increasing the debt ceiling. So I've put that up in the forum. So if you have an opinion on that, then go share it.
Yeah, it's another big one. It's another slow burn conversation that has a tendency to disappear and reappear depending on market forces. But yeah, and another potentially earth shattering. Am I being too dramatic? significant. Let's just go with significant question that the community needs to answer about how much DAI are we allowed to have in circulation. So that's an opportunity for people to speak on that as well. All right, thanks, LongForWisdom. That was great. Standard reminders apply. Join the forums and get involved with governance. If there's any more questions for Fluidity, we could give people 30-second window to make themselves heard. Otherwise, I think it might be a good point to wrap things up. Yep, okay, it's a good point to wrap things up. All right, thanks Validity for joining us. That was great. Thanks Vishesh, I think you probably left, but thanks for the numbers. Thanks for LongForWisdom for governance at a glance. And thanks everybody for joining us. That was a great call.
Yeah, thanks everybody.
Thanks, guys.
All right, bye.
Bye.